replays, just type in hashtag replay just so I know that you're watching.
Property guru George Markowski from Positive Property Solution joins us now. George, good morning to you.
How are you, George?
You've got to hang out with guys like George who know the numbers. Get the real numbers, the facts. Because I can talk to you about cash flow and all those things. George is better at that than me. The thing I'm ecstatic about George, he is a hardcore teacher. He really wants you to learn.
Okay guys, we've got 10 seconds left. Can't wait to show you a great, amazing session tonight. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1.
Welcome, Freedom Fighters. Welcome to your Thursday night. We're excited to be hosting tonight's session with Mike. Things of how to legally get your tax back. We're going to talk about investing in property. We're going to talk tax, depreciation schedule, V forms, accounts and management, and so much more. So, Mike is one of our circle of safety, and I'd like to George's personal wizard when it comes to George's own tax portfolio. So please, Mike, I'd love you to introduce yourself.
G'day everybody. Really great to be here. I hope you've all had a busy day and hopefully a productive day at the same time. Really super pumped to actually be here talking about how to actually try and maximise your deductions when it comes to rental properties. The Australian tax system has really been set up in quite an advantageous way so that you can actually negative gear properties and offset them against your other income. So it's quite attractive.
Great. And so if you can hear chat G to G, good to go. Please start typing in your questions because we've got some juicy questions. We'd love to hear from you. If you are watching tonight's live, please type chat, hashtag live. And if you are watching tonight's replay, just type in the chat play. So tell me more, like how can we really benefit the most with our tax portfolio?
One of the biggest things that I see in my profession, working with thousands of people across the country, is making sure that you get a tax depreciation schedule. These have some of the greatest tax benefits that you can derive. There are two components to it traditionally. There's a Div 40 deduction and a Div 43 deduction. Now, that's...
terms because those numbers, I'm just like,
Technical tax for essentially you've got fixed items within a property which you can't remove. So, you know, like your downlights, your tiling, your cabinetry, some of your shelving, and then you've got a whole raft of other items like stovetops, cooktops, microwaves, you know, things which are removable. That's the way I kind of like to look at the world. You've got the stuff which is fixed and you can't really rip it off without getting a sledgehammer, and then you've got all the other bits and pieces which you could probably remove with a screwdriver and a little bit of elbow grease. Those two things have slightly different depreciation rates. So newer properties have a really big advantage over older properties if you're looking to negatively gear and trying to generate some offsets against your income and looking for additional deductions. So the newer the property, the bigger the deduction is going to be. Traditionally, what you find is the fittings and the fixtures and the structures, they're going to depreciate at a rate of about between 2.5% to 4%, depending on the construction, and all the other bits and pieces. So your accessories, your fans, like the removable items, they will traditionally depreciate from about 10 to 25 to 40%, depending on the items.
got it. So with a depreciation, tell me, I mean, how many years your property be to get the most depreciation before? Is there a cap? Is there a limit?
There's no caps or limits as such. It's really what makes most sense. You can still organise depreciation schedules for older style properties. It's not really recommended to bother with any of that sort of stuff for properties which are older than 30 years old. Even like 20, you start to get into the fringe where a lot of quantity surveyors won't actually produce those reports for you because it doesn't make financial sense. It'll cost more to produce it than the benefits that you're going to derive from them. So you really want to, they're really useful for newer properties under 20 years. That's where you get where the benefits are there, especially the newest properties where you're talking like less than 5 years or even off the plan. That's where these schedules come in really handy to try and maximize the tax benefits to you.
Guys, so over the term of a depreciation, could someone expect to get back if they bought a brand new property on average?
In terms of what I see from brand new properties, you're talking about deductions of probably between 15 to 25,000 a year. They're usually a lot higher at the start because those fixtures, they tend to depreciate at a much faster rate compared to the building and the construction. So yeah, you tend to find some pretty juicy deductions for people, which can help offset other income against it.
And just to explain as well, I mean, when you do get a depreciation, you've got these numbers, and it says year one, your expected depreciation will be X amount. Now those amounts, is that how much money you're actually going to get back, or is it based on?
No, it isn't money that you're going to get back. It's a deduction against your other income. So if you've got a salary and wage, so you're receiving money from your employer, and let's just say you're earning $60,000, you buy an investment property, you collect the rent, and you report your expenses. This is an additional tax deduction which gets added in, and it's really an accounting entry as such because it's not a cash flow item. It's not money which you're having to pay out. It's an accounting concept in terms of depreciation. So it means that let's just say you paid $400,000 for a property in the first year. Hypothetically, let's just say you get a $15,000 tax deduction. The cost base of that probably tends to move to $385,000, but you're getting the tax advantage in that first year or in the subsequent years to help offset against your other earnings.
Got it. And then I guess, is it scheduled for, say, an employee versus a sole trader versus someone that has their, how does that actually look for them when it comes to their numbers?
Yeah, so it's quite advantageous to get these schedules in your own personal capacity if you're earning salaries and wages. It also works quite well for sole traders. When you've got probably a business, you may want to kind of consider getting some additional tax advice around how you kind of structure your purchase, just so you can maximize it for your own personal situation, because there isn't really just a broad brush stroke in terms of how best to structure your affairs from a, without kind of getting into the nitty gritty of what each person does.
Fan question from one of our, what does it really mean? Great question.
Yeah, it is. Again, I touched back on it. It's an accounting concept where you've got the underlying asset being the property that you've purchased. It is diminishing in value when it comes to the structure and the fittings inside. They're getting worn out, and at some stage, in the distant future, you may need to replace them. So it's kind of trying to use a concept of obsolescence and combining it with tax legislation to try and get people like a concept that, at some stage you may need to refurbish the property and make it up to, a better livable standard.
Mm-hmm. And we do have another, I do apologize, this comes up as Facebook user. I would love to know your name. On property, the legal costs and stamp duty, is this also tax deductible?
No, it gets actually added to the cost base of the property. So there are some particular tax rulings which define exactly what needs to be added. A lot of the water, the rates, the council adjustments, those can be deducted, but the actual costs incurred to purchase that asset actually need to be capitalised. So the legals and the stamp duty get added to the cost. Great question.
Fantastic. Great question. Yeah, now I keep cutting in and out every second word. Can someone just let me know, are you still cutting out? It could just be a bad internet connection. Yes. Or you can hear me, yes, you're still cutting in and out. Okay. See if I can fix up these technical issues. While I'm doing that, do you want to talk a little bit ITWV forms and
ITWV forms? Yes, these are probably the second most important thing to get organised after a depreciation schedule. So they're essentially income tax withholding variation forms. Fundamentally, what it means is traditionally your employer takes out the correct amount of tax for you each pay run. So, let's just say you might earn $2,000 for whatever pay period, and $400 hypothetically gets taken out as tax. What one of these forms allows you to do is put kind of your information together in terms of what kind of deduction you're getting from your property. Advise the ATO that what's going to happen is that you're going your taxable income is going to be lower due to the depreciation and the tax deductions that you're going to be getting from that property. The ATO stamps it off and says, yep, thanks for providing us this info. You can now use this form to provide to your employer to say, hey, Mr. Employer, you're taking out too much tax. I'd like a little bit of that back into my pocket each week or fortnight, or how often you get paid. So it's quite a useful form to help you with your cash flow and to get it in sooner rather than waiting until the very end of the year when you do your taxes to get a refund.
Got it. And with your ITWV for a property, is there a time that you have to wait before you can set that up, or once you get that started straight away?
No, you can get that started as soon as you have a investment property, because essentially it's kind of like an estimate in terms of where you see things landing. Because if you overestimate and your employer doesn't take out, if you overestimate and your employer doesn't withhold as much tax for you throughout the year, you'll end up with a tax bill to the ATO. But usually you try and get it, you try and figure out what your costs are going to be, and you try and get it as close as you can just to avoid that kind of surprise.
Got it. We have another question. Is my accountant supposed to submit this to the ATO form?
Accountants can submit it. You can submit it yourselves as well. It's mainly done on a bit of an archaic form which the ATO provides us. So either or works.
So let's talk about what are some of the things that we can expect on our investment property.
Yeah, probably the third thing which I tend to see quite often is the difference between replacements and capital assets. So when it comes to if you're doing any repairs and replacement work on a property, that is deductible for you. If you are adding new features like adding a new room or putting in an air conditioning system which never existed before, that is usually viewed as a capital addition to that property. So you want to try and strike the balance between when you're doing your repairs to make sure that if the intention is to do it for tax deduction, that you're really kind of doing more repairs and replacements, not new additions. So you just kind of want to watch that line, because the ATO is very clear in their guidance in terms of how that needs to be done.
Got it. And what about your interest on your loans, can you claim your interest that you with an investment property?
Yeah, definitely. You can certainly claim the interest which you incur on your properties. The banks always provide a nice schedule at the end of the year, which tells you how much in interest you paid for that year. You can even prepay some of the interest if you want to, depending on the style of property that you have, to gain additional tax deductions. So not a lot of people choose to do that option, but some people, where they've had a really prosperous year, may want to prepay their interest and get the tax deduction up front.
Fantastic. And look, when it comes to tax time, for some people it's exciting. They're going to get some money back, and for others it can be a really stressful time. So, since do you have when it comes to your home office kind of management, when it comes to your information for your portfolios to your accountant?
Yeah, look, we try and advise people to try and just keep a spreadsheet throughout the year in terms of what's going on. Usually, I just run a separate bank account where a lot of these transactions come out of, so that way I can just do one quick report and I'll just see what's there, rather than trolling through a whole raft of receipts. The other aspects I'd say is, if you're starting to feel anxious about where you might land for the year, is maybe start planning around April, May. Just figure out where you might be landing in terms of deductions, and try and figure it out before you get to 30 June, because that way at least you've got some time and flexibility to make whatever changes you need to. Maybe do some repairs, maybe prepay some interest, whatever that may look like within your personal situation, to determine what's going to be best for whatever tax outcome you're after.
Fantastic. We've got another question here.
Mm-hmm.
Where do we find what we can claim back on our investment properties?
Yeah,
Great
if you type
question.
in ATO rental, there's an ATO rental property guide. They update it every single year. So if you type in ATO rental properties 2022, you'll find the full publication in terms of income and expenses. So it is quite a detailed publication, because the ATO is well aware of the amount of rental properties which are held by investors nationally. And it's about a 52-page document which details just about everything under the sun. So that is a good spot to start with if you've got any more detailed questions. I unfortunately live and breathe this every single day, so have pretty good knowledge on it.
Great. We have another question. Say one bank account for tax. So, for example, have a credit card just for all your investment property?
No, I just sometimes do specific transactions. So if I've got a credit card for my investment properties, or a debit card for it, I just try and pay it out of one account, so I can quickly track those transactions without having to troll through all of my credit card statements at the end of the year. So that way I know that X amount went to the rental property, and I can quickly find it.
Please keep your questions coming in. I do have a quick announcement to working currently behind the scenes for our 2-day event that is coming up on December. We have a panel of amazing experts that are going to be talking and sharing all things. And for the first time, George has opened this event up to the public. Tickets $10, and we only have 15 spots left. But tonight, George really wanted to give back. We have a giveaway tonight. So for anyone that is interested in coming along, we have 2 free tickets that we're giving out to our lovely tribe. If you are interested in coming along to our 2-day event to talk all things property, please hashtag free ticket, and our team will put you into, and fingers crossed, you're one of our attendees. Are you coming along to that event, Mike?
Yeah, I think I will be. That way you can ask me any questions in person.
Fantastic. Love it. So keep it in. Anything you want to add, to this whole topic of how you can maximize the benefits of your tax in investing?
Everyone's going for the free tickets. Some of the other little minor deductions that I also encourage people to make, probably just you can do a basic home office claim for it as well. In terms of, you'd probably just say an hour a week in terms of managing things, so that'll get you an extra few dollars. The ATO used to allow travel claims, and they still do, but you've got to be reasonable about making any travel claims in terms of inspecting your property, especially if it's under management anyway and you're paying a property manager to do that for you. One of the interesting statistics which the ATO published recently is they did a random audit across investors across Australia, and they found 9 out of 10 had overclaimed their deductions on investment properties. So I do encourage people to ensure that they keep proper records, because if the ATO is finding 9 out of 10 people have problems, I can tell you what they're going to be doing over the next few years, and it's going to be a bunch of reviews on rental property deductions.
Well, we're really coming to the end of our tonight. Have any of those last questions, please bring them in, because Mike and I are going to go with our members and we're going to drill down even deeper on tonight's topics. Questions, please feel free to type in the chat. Let us know, and we can answer them before we head off to our next group. Oh, thank you so much. A lot of free tickets coming through, which is great. I think that might be a wrap, Mike.
Awesome. Well, that was a pleasure.
So fantastic.
Hopefully everybody got something out of it.
Yes, and thank you to our freedom fighters. It was a pleasure, an amazing Thursday night, and Mike, I will see you. Bye, everyone.